Good morning. Welcome to Stock Market Today. It's Wednesday, March 4th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today where you can sign up for a free email. Get a lot of the content for this show, as well as give you daily stock ideas to consider. That hits your inbox every trading day before the market opens. So U.S. equities finished lower on Tuesday, despite a 50 basis point rate cut by the Fed. All sectors closed lower on the day, with technology and financials underperforming. Defensive sectors held up the best. The dollar was down on the major crosses. Treasuries rallied with the curve steepening. 10-year yield traded below 1%. Gold finished up 3.1%. WTI crude closed higher by about 90 basis points. As we get to the desk this morning, we're getting a little bit of a rebound. Futures have been a little volatile as they have been all week, up about 2% on the day. Asian equities were mostly higher overnight, led by China and South Korea. European markets are moving higher as well. Treasuries are higher again with the curve steepening. 10-year yield back below the 1% level. Dollar is stronger on the major crosses. Gold is little changed. WTI crude is up a little over 1%. So as we kind of fade in here and look at the structure of the S&P 500, just a wild back and forth consolidation. We did fade from resistance despite a 50 basis point cut. Support remains in the 2,900 to 3,000 level. Resistance is in the zone between 3,100 and 3,200. RSI has leftovers sold levels, but is still in a bearish range, and Chaikin money flow is slightly bullish. So continuing to eye up the support levels, the resistance levels in the near term. Expect volatility to persist here over the next few days. Obviously, coronavirus matters. Obviously, what's going on in the Democratic primaries matter. I would expect that to lead to some increased volatility in the marketplace. Let's hit our market in a minute now. What are we writing about in our note today to Chaikin Analytics clients? Well, stocks fall despite the Fed's 50 basis point rate cut, right? A lot of people are calling it a surprise rate cut, but the market's reaction to it tells me I don't think it was a surprise at all. I think the market started to price in the potential for a Fed rate cut back on Friday afternoon and all throughout the day on Monday. We finally got the cut. So really it became a sell the news event. The real question is, will a rate cut help spur economic activity in the face of a virus that's spreading globally? I think that's what investors are trying to come to grips with. So with that in mind, we expect two-way volatility to persist. Sentiment indicators to continue to move towards fear. On Wednesdays, we do sentiment, and we'll take a look at that here today. Internet stocks show solid relative strength. Remember, we talk a lot about finding the areas of the market that are holding up the best. Well, in this case, we see an interesting ETF as a play on internet stocks that's actually held up relatively well, and we'll take a look at that a little bit later on in the show. And as I said, futures do point to a higher open here today. So taking a look at the major indices now from a power bar perspective, across the board selling. All of the major averages down over 2%. NASDAQ down over 3%. So the Dow gives back 2.9%, 0 bulls to 6 bears there. From a power bar perspective, S&P 500 down a like amount, 23 to 121, bulls to bears. NASDAQ, as we said, big underperformer. Tech stocks really got clipped hard yesterday. NASDAQ down 3.21%, 8 bulls to 18 bears. Small caps were actually a slight outperformer, in this case, down less. Down 2.08%, 150 bulls to 431 bears. Flight to safety lent a bid to bonds, on, especially in the back of that rate cut, right? Pushing bond prices higher, pushing yields lower. 10-year yield traded below 1% yesterday for the first time. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bearish. Major markets across the board, however, are mixed. Let's hit our stock of the day now. Remember, the stock of the day is auto-generated based on the power gauge rating, and then I analyze it for you here in real time. And this one actually looks compelling to me. Right? If we're looking for names that have held up, if we're looking for potential opportunities here, if we think the market's stabilizing, well, Select Medical, ticker SEM, which closed at 23.55, down 4.35% yesterday, has a very bullish Chaikin power gauge rating due to very strong earnings performance, very strong price volume activity, as well as positive expert activity. So when we take the 20 factors, 5 in each of these 4 categories, come out with our very bullish rating for a stock that's in a strong trend. Notice while a lot of stocks, if you're a Chaikin Analytics client, or if you're taking the 14-day trial, a lot of stocks have fallen below their long-term trend line. Select hasn't. still holding above the long-term trend line and actually triggered one of our buy signals here today. Analyzing the chart from the bottom up, ribbon at the bottom of the screen, the green means we're on a bullish or very bullish rating. We're outperforming the market. We're oversold with bullish money flow. Folks, if I had to outline the setups that we like in the marketplace, Select Medical fits the bill. If you're looking for a potential idea out there, I think you want to take a look at a name like Select, ticker symbol SEM, as a bullish idea here today. Within the healthcare group, that again is going to be volatile, keep it in mind heading into the election, but has been an outperformer. So take a look at Select here today. Looking at our sector tracker now, how have the sectors moved over the last 5 days? So very short-term rotation. But we're starting to see the kind of leadership at the top of the board that we like. Tech down 2.5% over the past 5 days. However, it is leadership. Healthcare, another one of the areas of the market that we've been highlighting of late because of its relative strength. Staples is defensive. Materials looks counter trend in nature. We do like comms, middle of the road, real estate, utilities. Obviously, falling rates helps those areas of the market. The question is how low are rates going to go? Towards the bottom of the list, discretionary industrials, financials, and energy. Obviously, the decline in rates is a headwind for the financials. Energy, I don't even, I'm almost tired of saying it, how bad it is. And there will come a point where the bottom fishers will be right. That's not our process. I'm happy to let the bottom form, let a base build, and start to see signs of an uptrend before getting excited about energy. But we're just not seeing it. Number one, from a price perspective. Number two, from a fundamental perspective. So continues to be an area of the market that we want no part of. Industry and focus today, REIT services, which actually has been an underperformer over the past 6 months, kind of surprisingly given what's going on with rates. Lagging the S&P 500 by nearly 10%. Its power bar ratio is weak, 16 bearish stocks, 3 bullish stocks, currently ranked middle of the road, 10 of 21 subsectors, having moved up 9 slots over the past week. Stock selection going to be important if you're going to go hunting for yield in the real estate play. You don't want very bearish stocks like Public Storage, PSA, Americold Realty, COLD, or Universal Health REIT, UHT. And if we take a look at the fund here, it's kind of surprising to me. I'm not going to lie to you. This is surprising to me, but the market doesn't care what's surprising to me. It doesn't care what's surprising to any of us, really. We just have to take the market as it is. So the fund has a neutral rating. There's a weak trend below a declining long-term trend line, and I'm actually just kind of surprised at how badly this fund was decimated. You would have thought there'd be a little bit of a flight to safety, but that's just not the case. Neutral fund underperforming as it has been since November. Bearish money flow. So not the area that I'm really want to be looking. Interestingly, if we're going to follow the process. Now, there are other REIT funds out there. It might make sense if you do think rates are going to go lower to focus on some other REIT funds, but certainly not this one. RWR, neutral, underperforming. Not one of the funds that we are super interested in taking a look at right now. But as I said, there are other funds out there that might be a little bit more compelling. All right, taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. Gainers side of the board, Newmont, NEM, big rally in gold yesterday following the decision by the Fed on rates. Gold ripped higher, it was up over 3%. Newmont goes along for the ride. CME, a lot of the exchanges are reporting volume data. They reported some ADV data yesterday. Market was up 3% in a down tape. And as you can imagine, with volatility where it is and volume spiking given the sell-off, you would expect the exchanges to see a spike in activity and a spike in volume. It's just a matter of what our expectations. As you'll see, Schwab is on the loser side of the board. Lennar up 2.5%. Home builders stand to benefit as rates go lower. LEN bucks the trend yesterday. Bullish rating at Chaikin Analytics up 2.5%. Welltower, WELL. It seemed that there was some misinformation as it relates to one of the coronavirus deaths here in the U.S. It was originally reported that it had taken place at a Welltower facility, but that appears to have not been the case. So that caused a snapback rally in WELL up 2.28%. And eBay, didn't see anything company specific on eBay, a blast from the past, one of the original big internet names. Up 2.11% on the day yesterday. As I said, no real news driving trading there. UNM on the loser side of the board down 9%. Nothing company specific to drive trading there. Schwab, they reported some volume numbers. Apparently, there was some level of disappointment there. Stock down 8.77%. Silicon Valley Bank, SIVB or SVB Bank, down 8.36%. As you can imagine, the banks were under a lot of pressure yesterday as rates moved lower. Again, I cannot stress this enough. The 10-year yield was under 1% yesterday. LNC down 8.35%, nothing company specific. Same goes for Raymond James Financial, RJF, down 8%. Obviously, the Fins were under pressure, but didn't see anything company specific to drive trading in that group, or in that name rather. Let's look at sentiment. Moves towards fear finally, right? We've been showing this chart for the past few weeks, the CBOE equity options put call ratio, and we were highlighting the fact that sentiment was so bullish that it was actually more bullish when the market topped than when the market topped in early 2018 and then went into a 21-month consolidation. We were more bullish this time around, at least by this metric. And even with the sell-off starting by the middle of last week when we showed this start, we were still frothy from a sentiment standpoint based on this metric. Now, other metrics had already started to move, but this one really hadn't yet. We've now worked off that froth. We can no longer say that sentiment is a headwind to the market. We can no longer say that sentiment is frothy in any way, shape, or form. This metric has spiked back to the middle of the range, but I will say that it has not hit those extreme levels of bearishness that we're seeing, such as back in December of 2018 or even the summer of 2019, but we are working in that right direction. However, the VIX, and this is why we look at more than one indicator, the VIX has spiked to levels that have tended to mark extreme panic in the past, right? I've given you a 5-year chart of the VIX here, right back in 2015, big spike towards 40. Early 2018, when the market began to sell off, big VIX spike towards 40. Late 2018, right, that December swoon, spike towards 40. And once again, with the sell-off, a spike towards 40. And I will say that the CNN Fear Greed Index that we publish in our notes, if you're getting them, is down at a 10 level. And that's a level that marks extreme fear in the marketplace. Just for reference, back here in December 2018, I saw 2 reading. So while there is room to move lower, sentiment is much more fearful than greedy right now, and you can see the VIX spike, and you can look at CNN Fear Greed Index on their site. Yields, right? The spike in fear leads to a flight to safety, right? Just kind of makes sense. And I didn't mark up this chart because I just wanted to let it present itself and kind of speak for itself. This is the 10-year yield. It's one that we look at a lot. And you can see just an acceleration to the downside as fear gripped the market, and then you get the surprise rate cut out of the Fed. Now, we did not close below 1% yesterday, but we did trade below 1%. I mean, if we wanted to kind of make a contrarian case in some way, shape, or form, we could argue that we are overly extended from the moving averages, especially in this case, the 50-day moving average, which yields have hugged the entire way down, and even when it tried to rally. And the fact that we are oversold, the RSI for yields is extremely oversold at this point. This is one of the lower levels that we've seen over the past couple of years. So certainly can't argue that the yield is extended to the downside. But that's a downtrend. There's no two ways about it. We are oversold. That kind of momentum confirms the trend. But just let's take a step back and think about this. Investors are willing to, in theory, lend the government their money for 10 years and in exchange take about 1% return per year. Think about that for a second and what that could mean for equity markets and what it could mean going forward for companies in different sectors and how they're impacted. We talk about it a lot, but I just wanted to take a step back and think about it. Finally, internet stocks are leadership. And one of the funds that we like and think looks interesting here is PNQI, the Invesco NASDAQ Internet ETF, right? And obviously it's choppy trading, a lot of beat up areas out there, but as we always say, focus on what's held up the best. On an absolute basis, we're between the 50 and 200-day moving averages and very much within a consolidation. RSI down near oversold levels, but what I'm interested in is the relative performance. After underperforming for quite a length of time, this ratio has now started to move to the upside, right? And it's held strong during this sell-off, right? Look at the relative strength here. Spike in price and then a sell-off. We've actually seen relative strength improve over the past week and a half of trading as the market has sold off. That's what we talk about when we say look for leading areas of the market. I drill down on PNQI and look at its holdings and look for some potentially interesting opportunities. That'll wrap us for today. See you tomorrow.